So let's talk about Wall Street crashing the crypto party. Everyone's buzzing about it, but we're going to look at this a little differently. We are going to pull back the curtain on the playbook they really don't want you to see and figure out how you can actually get ahead of the curve for the next big cycle. Let's jump in.
I mean, you've seen the headlines, right? They are absolutely everywhere. First, you get something like this. J. Morgan, a total giant of old-school finance, is rolling out its own coin. You can practically hear the gears starting to turn.
And it doesn't stop there. Next thing you know, Morgan Stanley's getting in on the action, filing for a spot ETF for Solana, which, as you know, is one of the biggest players in the game. The hype builds, right? The story gets bigger and bigger. And then? This. This is the big one. Bank of America, an institution that is famously careful, starts telling its high-net-worth clients, hey, maybe put 4% of your money into crypto. Wow. The suits are officially here. The bull run feels like a sure thing.
Okay, so all of this sounds incredible. I get it. But hang on a second. What if this isn't the rescue party we've all been waiting for? What if the arrival of these giants isn't about lifting all boats, but about setting a really, really clever trap?
And that brings us to a pretty stark realization. We are stepping into Wall Street's hunting ground. And let's be crystal clear about this. These folks aren't your buddies. They're here to build a system, their system, and make you the product. They want to turn you into exit liquidity. So if your whole strategy is just to buy a coin and hope for the best, well, you're not the investor, you're the prey.
So how do we flip this on its head? This is where our core strategy comes in, what I call the infrastructure thesis. The idea is so simple it's brilliant. Stop thinking like an investor and start thinking like a supplier. Institutions are building massive financial machines, and our whole play is to own the essential, non-negotiable parts of that machine before they even know they need them.
Now, when I say infrastructure, what am I actually talking about? Think of it like this. It's the gold rush all over again, and we're selling the picks and shovels. We're talking about the absolute core protocols that these big institutions simply cannot operate without. We're talking about high-speed data feeds, super secure bridges to move money, and, crucially, regulated ways for them to earn yield. And this really shows the huge difference in how people are playing the game. Most retail investors, they buy some Bitcoin, some Solana, and they just cross their fingers hoping the price goes up. Institutions, they can't do that. They have to build their whole operational setup first. They need the tools, the data, the yield, the bridges before they can deploy a single dollar at scale. We want to be on their side of that equation. Okay, theory is great. Let's make this real. With our first strategy, I call it the Solana ETF ambush. Now, everyone is betting that a Solana ETF approval will make the price of SOL skyrocket. That's the obvious play. But the real advantage, the smart money play, is owning the things an ETF provider absolutely must have just to make their product work at all. The first shovel you need to own is data. And not just any data. We're talking about lightning-fast, super precise data. See, ETF market makers live and die by speed. Nanoseconds literally equal millions of dollars. So for them, on a fast chain like Solana, Pyth isn't just a nice-to-have. It's the only game in town. It's the essential data feed they will have to use. And as ETF volume explodes, so will the demand for Pyth. All right, the second shovel is what I call compliant yield. Think about it. If you're an institution holding millions, maybe billions in Solana for your ETF, you can't just let it sit there collecting dust. You have to earn a return on it. And that's where Jito comes in. It's basically the perfect institutional solution. It gives them stable staking returns, it protects them from network risks, and, this is the really clever part, it captures MEV in a way that looks like a clean, compliant form of profit for their shareholders. It's a no-brainer for them. And the third and final shovel for this play? It's the bridge. These financial behemoths have money scattered all over the place, mostly on Ethereum. So, to get that capital into their new Solana ETF, they need a bridge. But not just any bridge. They need the most secure, most audited, most battle-tested one they can find. That is Wormhole. It isn't just a bridge, it's the primary artery for serious institutional money.
So here's the bottom line. While everyone else is scrambling to buy the gold, we're focused on selling the only shovels in town. We've got Pyth for the data, Jito for the yield, and Wormhole for the bridge. That right there is the essential infrastructure stack for any Solana ETF.
Okay, moving on to our second big strategy. I call this one JP Morgan's Toll Booth. This is all about their huge Canton network. Now, a lot of people are trying to figure out how to invest in it, but here's the secret. You can't. It's a private, members-only club for banks. But here's the thing about trillions of dollars in capital. It never stays locked up forever. It always finds a way out into the open market. And here is exactly how that private network creates a massive public opportunity. For JPM Coin to be useful at all, it has to be able to talk to public blockchains like Ethereum. So you just have to find the gatekeeper. And if you dig into the partners for the CAN network, boom, there it is. Chainlink CCIP is the official designated standard. This means every single time a transaction wants to leave that private network, it has to pay a toll to Chainlink. Owning Link here is literally like owning the only toll booth on the only highway out of JP Morgan's private city.
All right, our third and final strategy might just be the most important one of all, because this is about survival. This is the ultimate exit signal. It's all about knowing when the party's over and spotting that exact moment when the institutions are using all that positive news to dump their bags on everyone else.
Okay, so here's the signal. You have to watch the relationship between two things: the weekly ETF inflow numbers and the actual price of Bitcoin. When you see the news screaming about record-breaking inflows, billions of dollars pouring in, but at the same time, the price of Bitcoin is just flat or maybe even dipping a little, that is a massive, flashing red flag. It's a classic move called distribution. It means the big guys are quietly and systematically selling into all that retail buying euphoria. When you see that happening, it's time to be extremely careful.
So as we've laid out, when Wall Street finally arrives in force, the entire game changes. It's not the same market anymore. It becomes a strategic battleground, really, between very sophisticated hunters and, well, unsuspecting prey. And after everything we've talked about today, you're really left with a choice about which one of those you want to be.
You can be the client. You can listen to the mainstream story, buy what they're telling you to buy, and probably end up being their exit liquidity. Or you can get ahead of their moves, understand what they need before they do, and become the hunter. The choice really is yours.